architecture and apply it to our sphere of influence, the high-value payments space. So probably also worthwhile mentioning what this session is not about. We won't be talking about necessarily the phenomenon of cryptocurrencies, bitcoins, and the like, but rather the technology that underpins those and applying them to our regulated financial market infrastructures. So in phase one, last year, we were the first publicly acknowledged central bank and industry-wide DLT collaboration. That certainly garnered a fair bit of attention. And really the purpose of this was to explore, like I said, how a central bank might be fit into a distributed architecture. The very concepts are somewhat, there's some tension there in having an entity that is still the central authority in a network that is meant to be distributed and somewhat peer-to-peer, if you will. We used the Ethereum platform, which is and still is to this day a leading technology within this space. And we discovered, quickly that there are definitely pros and cons with respect to the architecture of that system, how the database is shared, understandably in these sort of open and unpermissioned environments. And so when we looked at our use case, eventually we realized that the consensus mechanism and this broad sharing of data across the network didn't quite fit. Certainly, I'm sure Andrew would state that if he was sending a payment to CIBC, he wouldn't be particularly keen for TD to have that data set at their fingertips or vice versa. So we have a different use case and we have different requirements. All that said, it was a great experience for the developers at the banks, for the business leaders and the technology leaders within our various organizations. And we said that, this is research that's worth undertaking. And we established the problem set for the next iteration in phase two. So specifically, we're looking to solve for this privacy dimension in that if we're going to reimagine a payment system on a distributed architecture, we want to do it in such a way that only the participants that need to see the data should see the data. The other issue that's maybe worth mentioning is with respect to settlement finality, and I've kind of glossed over another fact, is we're really coming forward with the lens of the principles for financial market infrastructure. And so there's a list of 24 or 7 rules, Rod. And anyway, we're using those as our baseline requirements to say, these are the objectives. Can this technology meet or exceed our principles for financial market infrastructure? And settlement finality was another one that got a little bit of attention with respect to how these technologies achieve consensus and how transactions are validated. So in phase two, in conjunction with our partners from R3, we decided to re-platform away from Ethereum and onto R3's Corda platform. We looked at a couple of other technology stacks, but this one was a natural fit, and we thought we'd give it a try. So in phase two, a good chunk of this software development work was in fact re-platforming the application itself, which we will show you in a few minutes, in such a way that now only the entities involved in a transaction will be party to that data set. And so that was a marked improvement from where we started in phase one. Corda is an interesting beast. It's really not a blockchain at all. So for those of you who studied this, it's really a mix of centralized and decentralized components. There are shared ledgers between participants, but there are also services that are quite centralized in a very traditional fashion. So in particular, rather than having a consensus mechanism that validates transactions and relies on this shared database, there's a service called a uniqueness service, basically. And this notary validates that, an asset cannot be transferred more than once. So the phenomenon of a digital asset is you should not be able to copy it. The requirement is if I have $1 and I send it to Andrew McDonald here in the front row, then I shouldn't be able to spend that twice. So that's how Corda solves that problem. There are other services that are centralized. In particular, we also wanted to add in the functionality that is common to many, if not all, but many high-value payment systems, and that is one of a liquidity savings mechanism. So these are core functional features of a high-value payment system that need to be contemplated, and we thought we would take a run at building that into the Corda platform in our prototype. So that is exactly what we did, and we're here pleased to be talking about that here today. And basically, this illustration shows our general kind of flow within the application. First, banks, as last year, in last year's presentation, would pledge collateral to the central bank. That would be done in a production sense. Today, we would actually use a traditional payment rail like LVTS to do that. The bank would then pool that collateral into a special pooled account, and they would then generate these digital dollars. Last year, we were calling them CAD coin, and for various reasons, we've now landed on a different term, which is digital depository receipts, DDR, not quite as catchy, but we're working with it. The central bank would then generate and fund the wallets of the participants on this network. Banks could then exchange payments via peer-to-peer exchange of digital assets. At the end of a day or a cycle, they could empty or redeem their wallets back to the central bank, and then the central bank would archive the tokens so that there are no more on the network, and essentially retire them from operational use. Again, in Corda, there is a centralized service called the notary, which performs this uniqueness function and ensures that there's no double spend. And we've added in this LSM, which is the unique feature of a high-value payment system. So to go into more detail on that, I'm going to pass the mic over to Rod Garrett, and he'll take it from here.
Is that yes? Thank you. So I'm going to describe to you how the liquidity savings mechanism that was implemented in Project Jasper works. So as Deputy Governor Leduc said in his keynote speech earlier today, historically interbank payments were made using deferred net settlement. And what that means is that banks basically passed around IOUs all day and then settled in cash at the end of the day. But over time, increase in globalization in financial markets and the creation of new financial derivatives led to a large increase in values and volumes going through payment systems, and people became uncomfortable with the risk that was inherent in these netting systems. And this caused countries around the world to implement what are called real-time gross settlement payment systems. What that basically means is cash in advance. So in order to make a payment, you have to have the cash. So what this did is it eliminated credit risk in the system because payments were all covered by cash, but it greatly increased the liquidity requirements of the systems. Therefore, banks began to supplement these systems with liquidity savings mechanisms. That's what LSM stands for. And the most popular of these mechanisms, the most effective, is a periodic multilateral netting system, which basically takes payments, puts it in a queue, and allows them to be settled on net multiple times throughout the day. Now, not all payments can be settled that way. Some payments are urgent. CLS buy-ins have to be done immediately. And so banks always have to have the ability to make pure RTGS immediate payments. And so on the Jasper platform, we allowed for two possibilities, two ways to make payments. One is the standard pure RTGS, which we call atomic. You make this payment, you have the cash in advance, it immediately settles. The alternative is that you can send a payment through this liquidity savings mechanism. And as I mentioned, the way it works is on this diagram. So the idea is that throughout the day, you have set time intervals whereby banks can submit payments to a queue. When they submit the payment to the queue, they're not charged any liquidity. This is just a notification of a payment that they want to make. So a bank would do this for payments that are non-urgent. Most payments or all payments have to be made at some point during the day, but not all payment requests that banks want to process have to be processed immediately. So banks can put it in a queue. This queue may only last a couple of minutes. That's a parameter that the bank can set. So the queue will collect payments, and then at a certain point in time, there'll be a matching cycle, and all of the payments in the queue will be matched up, and net obligations will be computed, and those payments will be made. And as I said, this process repeats continuously throughout the day. The reason the matching cycles should be, or the queuing periods should be short, is that banks do not want to delay payments for too long. All right, this allows banks to make a payment almost real time, but have the potential to have some liquidity savings. Okay. So how do we implement a liquidity savings measure, a mechanism on a distributed ledger? As Andrew mentioned, it's kind of an interesting challenge because distributed ledgers are inherently decentralized and a multilateral netting queue is inherently centralized. The way we did it is as follows. The queuing mechanism itself does exist as a centralized mechanism, but we have to draw payments, liquidity, from the banks over the system. So the idea is that once the queuing period is over, we draw liquidity from banks to the central bank node. This has to be done because before the matching algorithm runs, the bank has to know how much liquidity is available from each bank in case matches aren't perfect. So not all payments that are matched are perfect matches. It's not a 10 million payment against a 10 million payment. It may be a 10 million payment against an 8 million payment, in which case we need 2 million in liquidity. So before the algorithm runs, we need to know how much liquidity is available. And so before it runs, we do an inhale of liquidity from all the banks, which is the liquidity that's available to cover these imperfect matches. The matching algorithm runs, figures out the net obligation of each banks, sends the money back to the banks, and the process repeats. While this is going on, banks are still able to make real-time gross settlement payments through the atomic stream with any liquidity that they did not contribute to the matching algorithm. Now some math. There was a few eyebrows raised when I submitted this slide, but I think I can give you a very good indication of how powerful the liquidity savings mechanism can be. If you look at the column vector that's denoted by L, that stands for liquidity. Think of that as the amount of liquidity that each bank gives to the system during the inhale phase. So think of that as being, say, $2 million each. There's just 3 banks in this simple example. And the matrix A on the left is meant to be a simple example of a payment file of payments sitting in the queue. So if you look at the top row, 0 means that bank A is not going to send any money to itself. But the second bank, but it is sending, say, $10 to bank B and sending $1 to bank C, or the third bank. So that top row is the payment request that the first bank has sent in for banks 2 and 3, say, maybe easier. Likewise, the columns represent the payments from bank 2 to bank 1, number 8, and from bank 3 to bank 1, the number 5. Why is this useful? If you sum up the rows, all right, then that tells you how many payments bank 1 is trying to make, the first bank is trying to make, the total amount that's trying to send out. And the column sum, if you summed up the first column, that tells you how much money bank 1 has coming in. So the difference is the net payment obligation of the first bank. So that's the number 2. The payment obligation of the second bank is the number 1, and the payment obligation of the third bank is 3. So what we have here is that after we run the netting algorithm, when we clear things up, only bank 3 is going to pay money. They would owe 3. And bank 1 would receive $2 or $2 million, and bank 2 would receive $1 million. Those numbers are negative. They'll be amounts owed. Now there's a problem. We had to decide how much liquidity was available for the netting algorithm. As I said before, we're imagining that each bank contributes $2 million. So this can't be a solution because it requires $3 million from the third bank. Okay? So what do? What you do then is you then have to remove a payment from the queue. The way the jumbo queue in the LBTS system currently works is it removes the last payment by the bank that's in that negative liquidity position. Okay? What we do in Project Jasper is something that's a little more optimal. We start by removing the lowest payment from the bank that's in a negative liquidity position. So in this case, we remove that payment 2. If you look at the bottom of the top of the A matrix, it's the payment from the third bank to the second bank of $2 million. Once we remove that payment on the very bottom and go through the same process, I won't go through it again, but what you see is that we have now that the first bank is owed $2 million, the second bank owes 1, the third bank owes 1, and all of those are less than the amounts of liquidity available, so that runs. Okay, that's how the system works. It's not always going to work on the first iteration, but it will optimally remove payments until it clears as many payments as it can. The last thing I'll say is that if you look at all the numbers in the A matrix, these were all the payments that were put into the queue, all those numbers add up to 29. So $29 million worth of payments that the system was trying to process. If you look at the solution in the bottom, all of these payments are going to be processed by the second bank providing $1 million in liquidity, the third bank providing $1 million in liquidity. So $29 million worth of payments are processed with $2 million worth of liquidity. So that's the savings that are inherent in this type of liquidity savings mechanism. Okay.
Thank you, Rod.
Okay.
Check. So I love that we used some math today, which is great, and there will be a test at the end, of course. And this is actually a simplification, and just a quick shout out to the development team, the names on the bottom. These are the guys who did all the work developing the platform, and in fact, this is a simplification of our LSM. It's actually a three-dimensional array because this only captures one bank payment to one other bank payment. In fact, you can have many bank payments to another bank payment. So there was a lot of energy and interest around this from the development perspective. So we will now do a quick, oh, you had one more animation, but we'll skip that. So now we'll do the quick demo. We're going to log in as BMO on the top left-hand side. And this is our UI. We've improved it from last year with various graphs and charts showing in and outbound payment flows. You can see that we've already got some DDR balance in the wallet of BMO in this case. And we want to quickly show that first step in the life cycle on our network, which is the pledging of collateral and the funding of the wallet. So in this case, we will, BMO has already sent a pledge request to the central bank for $500,001, which is there. And that transaction is a two-step process. So that request goes to the central bank. You can see a little bit of activity on the central bank side here to show that they now have some action to take. So they would, first of all, you can see that they can see all of the DDR, all of the cash on the ledger. They can see that they've got a pending pledge request here. They can view the details. This is where the collateral pooling would happen in the background at the bank. And then they can generate the digital asset and fund the wallet of BMO. So now BMO's wallet, if all goes well, should be increased to the tune of $500,001 or DDR. They are now ready to make payments on the network. And the first, so there's the balance in the wallet. The first type of payment that Rod referred to is the atomic payment. So this is really that real-time gross settlement payment, if you will, point-to-point, no fancy LSM in the middle. So in this case, we will have BMO send a payment of $300,001 to TD. And you'll see a tiny bit of activity in our Blockchain Explorer window there. That's the notary notarizing the payment and the funds moving from the BMO to the TD wallets. So it's hard to make this stuff more exciting because it's pretty basic flows, but there's a lot going on in the background, and we've always sort of struggled in terms of how to demonstrate this, but bear with us. So you can see now that the TD wallet is, has been credited, and obviously all of their transactions, recent transaction activities would be available to the cash managers using the system. So there's the successful $301,000 transaction. So now what we want to do is show the LSM, so the new feature that we built in this phase of the project. So we'll log in as a different bank, CIBC. And you can see on the bottom of the screen, they already have 3 payments that have been sent via the LSM queue. We'll add one more to that list, send a $200,001 payment to RBC, and the payment instructions would be then queued up at the central bank node on the network. So that's what was just visualized in the Blockchain Explorer window. So now we've got 4 payments in the queue, and this is CIBC only seeing their data, only the payments they have added to the queue. And now logging back in as the central bank, which can see both the current limits. So this is the this is the constraint on the algorithm that Rod was describing, how much money the banks are willing to pledge to the LSM, as well as all of the queued payments in the entire network from and to every single participant. So the bank obviously has special privileges in this regard. We run the netting algorithm, and this is where the inhale-exhale process happens. It happens pretty quick. This is the DDR moving to the central bank. The algorithm runs very fast in this case. The solution is found, and then the funds are returned to the participant banks, long and short respectively, as well as all of the pledged collateral that they had put in, the liquidity they had put in, sorry, not collateral. So these transactions are obviously visible. There's transactions to and from the Bank of Canada, so those are the inhale-exhale transactions. And all of the LSM queued transactions that you can see here, we're on BMO's screen, all of the queued payments they have now been processed, and so those are final and irrevocable payments via the LSM. So what we've done here is really replicate what you would expect to see in the operational side of a high-value payment system. The last few screens, the LSM balances are now zero, so the cash managers know that they do not have any pending payments. And the rest of this demo basically will highlight the final few steps of redemption and closing out of the cycle of the day. So I think we can probably skip that in the interest of time, and I'd like to pass over the mic to Graham next, who can speak on behalf of the Bank of Canada in terms of participating in this project.
Thank you, Andrew. So I've got no slides, no math at all, so this will be an easier version. I was going to, I guess, talk about two main topics. The first quickly is why the central bank, the Bank of Canada, is really interested in this. And then the second is what we learned going through the process. So briefly with why, I guess I'd say there's sort of three reasons for our interest in Project Jasper and in a DLT-based wholesale settlement system. The first is that we're a participant, and I think we're a pretty key and pretty special participant. Final settlement occurs on our books in central bank money, so we're an integral part of this system. We essentially need to be involved in any high-value payment system that's going to be compliant with the PFMIs, with the Principles for Financial Market Infrastructure. Also, in terms of a participant, we do use the system. We make payments on behalf of our clients. The federal government's probably the biggest, but there's other FMIs, foreign official institutions, other clients that we do make payments for. So as I said, one is a participant, two is as a regulator. Under the Payment Clearing Settlement Act, we have regulatory oversight authority over designated financial systems, systemic and prominent, so a clear interest in having a wholesale payment system that is sufficiently risk-proofed and compliant with the PFMIs. And then the third is just an overall interest in the financial system in general, the efficiency, the safety, and soundness of the financial system. Obviously, DLT is a pretty new and pretty exciting technology and something that I think a lot of people believe can have a fairly significant impact on the broader financial system. So this gives us a chance to work with it and get a good handle on that. So turning to sort of what we learned from going through this, I'm going to open with the fact that certainly from our perspective, this project was a great success, both phases of it. Probably the biggest, or one of the biggest successes was just the lesson that how effective the sort of public-private sector collaboration is. I think we learned an awful lot about each of our various roles within the wholesale payment system, what the central bank does, what the operator does, and what the commercial banks do, and indeed just sort of how complicated and important these various roles are. We also, going back to phase one, successfully built a DLT-based system that could exchange value back and forth. It was an operating high-value payment system, and it was compliant with most of, not all of, but most of the PFMIs. And I think that was a pretty significant achievement. And it led to this phase that we've done here, where we tried to go a little deeper and address what we saw as sort of some of the shortcomings. And I'll just touch on three of those, and I think they've already been alluded to: privacy, scalability, and finality of settlement. And for various reasons, the proof of work type DLT, so Ethereum with the first one, wasn't really up to the bar in those three areas. So with phase two, again, as Andrew said, we went to Corda. and we addressed this. It's no longer a proof of work system, so it addressed the privacy concern. Each node could only really see, they only saw a subsection of the ledger, so they saw what they needed to see and not everything else. Scalability was dealt with by the fact this wasn't proof of work anymore. It was a notary system, so they could be much quicker. And again, the finality of settlement was proof of work is a probabilistic settlement, and notary is full final settle. So it seemed to address those problems, but at a cost. And the cost is the gains in resiliency that you got from using a distributed ledger. We lost a lot of those because, you know, with phase one, every node was a duplicate of every other node, and if one went down, it was fine. All the others could manage this. This is no longer the case. Each node was sort of somewhat special, and therefore they all had to be highly available and fully backed up. And in particular, the notary needed to be highly available and fully backed up. And as both, I think, Andrew and Rod mentioned, the LSM, but some other characteristics as well. I mean, a high-value payment system is inherently a central system. It needs to have this sort of trusted party at the heart here in terms of the central bank. And while we worked around that, it probably wasn't the most efficient way. So I think what we took away from this is that under the current technological platforms, at least, it doesn't really seem that a DLT-based system is going to be better or dominate the sort of more centralized systems. So, you know, really, for a standalone high-value payment system under the current technology platforms, DLT is probably not going to push the current systems out of the way. But it did, as these things often do, I think, just open up a whole bunch of new avenues for further work. You know, I said it's a standalone system. Didn't seem that this would be a better way forward. But the strength isn't really in a standalone system. It's likely that there's going to be some benefits from its ability to link with other FMIs or with other assets on other ledgers and sort of work you know, cooperatively. Things like being able to post collateral other than cash. Things being able to hook up with other DLTs, either domestically or internationally, perhaps for security settlement, perhaps for sort of cross-border transactions. These are all areas where there may well be a case for improvement, and areas I'd suggest that there'd be some interest in doing further work on. So with that, I'm going to turn it over to Andrew. That's the sort of central bank view. We'll see what the commercial banks think.
Thanks, Greg. First, a few comments. So the first thing I would say is it's a real privilege to be doing some of this work right here in Canada. And some of the things that you saw my colleagues talking about earlier are really leading edge thinking in terms of DLT applications and how DLT solutions can actually potentially deliver on use cases that we see in transfer of value across financial asset classes. And the thinking around the LSM, the thinking around how we can take a DLT application, a permissionless application, and build it in a way that has real relevance to how we need to transact in some of the financial ecosystems that exist today, I think very, very interesting. And so the fact that Canada is leading some of the thinking here is excellent. And I can tell you that some of our international commercial banking counterparts are very, very interested in the learnings that we're, as a Canadian banking group, undertaking. So that I think is quite exciting. I would share some of the learnings that Graham was talking about from a commercial bank perspective. I am speaking on BMO's behalf, but I suspect many of my comments would be shared by my counterparts at the other commercial institutions. The first thing here is that, and there's been some press around whether or not DLT is going to actually support our near-term modernization efforts that are being driven by Paiements Canada, and I'm not going to necessarily comment on that. But whether or not they will, what I can tell you is that as a commercial bank, the learnings that we have captured from this work are going to be useful for us in all the other likely use cases for a DLT system. Because if you think about it, any type of financial asset class has a cash transaction likely incorporated in it. If I am passing a source of value or to a different counterparty, one of the mechanisms that is likely to be involved is a payment of some sort. And so the learnings that we have captured here around the cash on ledger are highly transferable for us as the banking industry look at all the different types of use cases where distributed ledger technology may provide real enhancements to how we currently look at trading and settling assets. Some that come to mind as I stand in front of you would be trade finance, a very, very paper-intensive process today that hasn't seen much innovation in 50 years, could really benefit from some of the real-time settlement capabilities that we have here and the distributed nature of a ledger system that I think have real near-term applicability. And there are many others potentially in money markets and other asset classes. And the other thing I would highlight that was valuable to us here at BMO was the fact that some of our very best developers were working on this thinking and really leaning in on it. And the learning opportunity for us to actually put some of our best people working in a industry setting like this is value that we will be able to repurpose on an ongoing basis. So this was for us a great example of how Canada's frankly leading the world, where you have private sector, you have the payment system, and then you have the government bank institutions all working together in a way, frankly, that's the envy of many of our international counterparts. So with that, maybe I'll pause, Andrew, and hand it back to you.
Yeah, I think that's really the ground we wanted to cover today. I think notwithstanding the fact that we've come out saying that this technology might not be purpose-built for our wholesale payment needs, we do see this work as contributing to the dialogue and the future of distributed ledger technology. And I can also say definitively that we've also been informing the development of these very platforms that we've been working with. So it's very much a two-way conversation, and we've been able to, through these initiatives, actually contribute to the knowledge base and the development of this whole space. I think we've only got about 4.5 minutes left, so maybe we'll open it up for some questions. Yeah. So if anyone would like to ask a question. See, I'm smart because I brought all these guys on stage, and they're very, very capable of taking tough questions. So feel free to direct anything you want to them. Hi.
Hey.
Hi.
Great panel. Thank you. My name is Kesem. I work for a company called Nuco, and I'm a big fan of the project. My question is about the decision criteria, or maybe considerations that you went through between phase 1 and 2. Because you went from probably the most open, permissionless, borderless, actually, blockchain out there to something that isn't a blockchain at all. And I wonder, my question is, did you consider any of the enterprise-specific blockchains that address a lot of the, the concerns about privacy, security, performance? Or is there a reflection here about blockchain itself as an architecture? What were the group's thoughts, I guess?
I can take that one. I mean, we did go through a process and look at Hyperledger and briefly at Quorum as well. So we were aware that there are other possibilities. At the end of the day, I mean, somewhat obviously with R3 as our partner, there was a decision to try their platform and see if it would meet our requirements and work for our use case. Not to say that others couldn't do it in a slightly different fashion. And to be totally honest, it wasn't obvious. I mean, notwithstanding that Corda is not a blockchain in the traditional sense of the word. It does have distributed ledger facets to it. There are shared ledgers. So there is a spectrum here, and yeah, we did go from perhaps one end of it to the other. Not to say there aren't other possibilities or even design patterns that we could have used. Quite frankly, our LSM was built as a centralized component. It is possible through some multi-sig smart contract you could achieve the same thing, and that would be a very different design pattern as well. So, but you do have to make choices as you.
Yeah, I would just add, if you sort of take one of the key lessons out of this, that a fundamentally centralized system like a high-value payment system maybe isn't the best standalone application for DLT. I'm not sure that would change depending on which specific platform you'd used. I mean, I think our lesson here is that maybe we're best now to look at applications that cross asset classes, that cross ledgers, that cross different financial market infrastructures. I think that was one of the key lessons out of this, and I think yeah, we did jump from one end to the other, but I'm not sure that sort of fundamental learning out of this would be any different, and I think it did highlight the most fruitful area, or what we see as a potentially very fruitful area for further work.
Thank you.
Mike One.
Hi there, Martin Kyle from Central One. So I'm just going to read this question because it took me a little while to compose it properly.
We'll take time to answer.
Yeah, so consensus algorithms for blockchain technologies like proof of work or proof of stake protect the monetary system from a security perspective as well. Each block is computationally linked to the history of all preceding blocks, as you're aware, to prevent chain forks or double spends. With the centralized notary performing the role of a consensus algorithm in this case, how would you compensate for the reduction of security for the gains of the notary, namely privacy, scalability, and finality?
So, I mean, I'll take a crack at it. I think it does put the onus on, first of all, it's a closed system. This is not a public blockchain, so it's only the internal participants who have access to the nodes. But it certainly does put the onus on the notary for that level of resiliency. That you've got to, resiliency to always be up and operating, but also resiliency to be very secure from cyber or any sort of other, attack on the payment infrastructure.
Yeah, I just think it's also important to recognize that there's also a trade-off that when you want to run a sort of a broad consensus proof of work type system, there's a lot of costs associated with that. If we think about just sort of the computing costs associated with doing that type of transaction verification, in a trusted system that just isn't necessary. So it's you have, given that you're able to depend upon a trusted counterparty, then it makes sense to use it, I think.
I might make a comment that I suspect as use cases formalize, that you're going to see distributed ledger capabilities manifest in many different ways. And it's not necessarily a success or a failure if, the purest form of a distributed ledger is deployed. It's about what are you solving for and how best do you solve that problem. And so in this particular case, there were aspects of a pure distributed ledger that didn't necessarily fit with a future state ecosystem. But I think going forward, there's huge value for an industry to leverage this notion of distributed computing. So you're not just aligning on a message format, but you're aligning on a broader set of the technology ecosystem that will save cost, improve the real-time nature of settlement, and link information around an asset class to the payment for the asset. And those are hugely beneficial for us.
Hi, I'm Therese Couture from the Banque of Canada. There's a lot of talk about collaboration here this week, which is a great topic. And this is a great example of collaboration across industries. Can you talk about what some of the challenges were and what went well? And how did you do the decision making in this process?
I guess I should probably take a run at that.
Oh, yeah, that's you.
So, yeah, I mean, it is a unique opportunity, but it does come with some challenges to run a project across 7 or 8 different institutions. We all have different standards in terms of project management, expectations around how the projects themselves should be managed and delivered. Resourcing is always an interesting conversation. Access to business domain expertise. These are all things that really are key criteria for success. We did find a way. I won't say that it was, I wouldn't gloss it over and say it was extremely smooth or pretty all the time, but you know, the banks have been all very, very actively building up their incubators and digital garages and stuff, so the development resources available are generally there and quite strong. The business expertise from the clearing and settlement perspective, from the bank, we've got it. We bring in people like Rod on a case-by-case basis to help kind of complement the team. I think the one challenge, you know, understandably, was getting access to business operational resources in the commercial banks. And understandably, they have jobs and they're very important jobs. If you're working in the Treasury, you have a very specific job. And so getting access to them is always a bit of a challenge, and their mandate is not to participate in research activities like this. So I think if we were going to do something, you know, again, and I think we've alluded to at least one use case that we would like to work on collectively, we would continue to refine our process in terms of doing these collaborative industry-wide projects. But it does work, and it's really a coalition of the willing, and quite frankly, with this space and this technology, there is quite a lot of willingness to participate. So thank you all for your time. I appreciate it. I think our session's up. So yeah, appreciate it.